Currency crisis. Will China dump the dollar? Money, money everywhere, but markets hiccup. At the start of the last century, China stuck with silver, while Japan and the United States, among others, based their finances on a gold standard. The U.S. was then the new upstart superpower, and it took decades to sort out global currencies as the British pound sterling faded, and Germany and China after it suffered from spectacular inflation. At face value, the situation in today's currency markets looks a lot like the mid to late 1980s, when U.S. policy deliberately decimated the dollar in response to its trade and government deficits. Add to that the blame Japan strategy and the forced appreciation of the yen, and you can see how many think the solution is for China to rapidly exchange value for its currency. And so louder calls for yuan appreciation from the United States, Treasury Secretary Paulson speaking from Africa, and Europe with French Finance Minister Christine Lagarde echoing calls from Jean-Claude Trichet, head of the European Central Bank, for China to inflate its paper money. But while central bankers and politicians of the G7, G10, and G20 ramp up the rhetoric to show markets they are concerned, reality is exchange rates appear to have a logic of their own, not necessarily driven by trade balances or imbalances. Globalization has reached such new heights and interconnectedness that it is not currently clear whether the world is decoupling from dependence on the USA or rebalancing by encouraging, if not creating, a slowdown in the American economy in order for emerging markets, that is, poorer countries of the world, to catch up even faster. One thing is clear: China and oil exporters are benefiting the most from the first decade of the 21st century, draining dollars and increasingly euros and yen. China's trade surplus with the USA has grown almost 60% since the start of the year. The EU is an even bigger export market for China. Meanwhile, the foreign exchange reserves, primarily denominated in US dollars, of oil exporters from OPEC to Russia have swelled all year. Both are now seriously concerned about the fate of the US dollar and actively seeking diversification away from US dollar currency pegs. Speaking in Singapore at a business conference, Chinese Prime Minister Wen Jiabao said, "We are worried," adding his voice to others in China's top leadership for divestment out of greenbacks. Chinese ministers will be meeting this month and next with their European and American counterparts in what will certainly be a contentious, if not productive, conversation on their intertwined units of money. This past weekend, for only the third time in its near 50-year history, the Organization of Petroleum Exporting Countries, or OPEC, gathered heads of state in Saudi Arabia to discuss direction as the dollar decline alarms its financiers. The ministerial meeting was held behind closed door, and I have not found any disclosure yet of what was said. Oil production was not a topic. That will be discussed in another meeting scheduled later. One note of possible interest regarding China: OPEC Secretary General Abdallah Salem al-Badri was in China only 2 weeks ago and met with officials of China's national government and said that the group can meet China's energy needs. The most recent figures on China's oil imports show that Saudi Arabia is now the #1 supplier, accounting for over 18% of Chinese crude imports at over 3 million barrels per day, twice the amount Saudi Arabia exports to the USA. The growth of money supply in China appears out of control, according to otherwise more sober analysts in Hong Kong, fueling inflation and leading to general fears that Beijing will be forced to put on the brakes to rein in China's growth sometime in the second half of 2008, at just the moment when the United States economy is supposed to bottom out. The M2 money supply expanded at over 18% and inflation at 6.5% last month, an 11-year high. Food inflation is the biggest problem, running at almost 18%, with prices for meat up near 40%. This is a very serious concern, as high food prices are a traditional source of unhappiness among Chinese with their governments. There are widespread reports of deliberate but selective curbs in bank lending, particularly in real estate, although the China Banking Regulatory Commission officially denies any credit freeze is underway. Real estate investment is said to be in surplus or excess capacity. One indicator, prices of land, are breaking new records. A Singapore developer recently paid 20,000 yuan per square meter, or about $1,000 a square foot, for land in the new Jiangwan town area of Yangpu district in Shanghai, a new center of gentrification. That puts Shanghai land values almost on a par with London or New York City. The Shanghai Composite Index continues to slide, ending down every day since our last show to close November 19 at 5,269.82. All markets have underperformed over the last few days, with few small exceptions. The CSI 300 index ended down again today to close at 4,994.416. Even with declines, however, it has tripled in the past year. Shanghai B shares are up a fraction to 330.353 after 3 days of declines, and the story is the same for Shenzhen Bs, closing November 19 at 708.931. The individual investor program that was the hope of Hong Kong remains delayed, and a Credit Suisse analyst now says it won't be implemented until the second quarter of 2008. The China Securities and Banking Regulatory Commissions disagree over the scope of the program. The Hang Seng reacted negatively to this news, but most analysts still expect the market to absorb potentially billions from individual Chinese investors and the anticipation to inflate Hong Kong's economy. For viewers in the USA and Canada this week, happy Thanksgiving. I'll see you next time.